formally introduce our panel of experts today, from ATR Asset Management, we have Mr. Phillip Hagedorn. He is currently the Chief Investment Officer of the Atram Group, responsible for the overall management and administration of the investments team. He has 28 years of experience in equities and asset management. So we'll hear more from him later. From BPI Investment Management, we have Mr. Jose Marie Sem Valmayor. So he's currently a fund manager at BMI after being with BPI since 1997, which includes a stint at the bank's asset management and trust group, where he handled both peso and dollar denominated unit investment trust funds. So he's currently overseeing the PAMI fixed income funds. For First Metro Asset Management, we have a returning guest expert, Mr. Edser Trinidad. So he's currently the head of investment and research at FAMI, and he brings with him more than 25 years of experience in the financial and investments industry. Another returning speaker this afternoon is from Philequity Management, Mr. Miguel Agarao. So he's currently the Vice President of Philequity and helps manage different funds under the firm. He brings with him more than 10 years of industry experience, and he is responsible for crafting and presenting Philequity strategy to clients and investors. And finally, we have from Sun Life, Mr. Ritchie Teo. He is a fellow CFA charter holder, and he is currently the head of fixed income of the investments department of Sun Life of Canada, Philippines, where he oversees the management of bond funds, money market funds, and global fund of funds of Sun Life Asset Management. Recently, he was appointed as the Deputy Chief Investment Officer and Head of Fixed Income of Sun Life's new entity, the Sun Life Investments Management and Trust Company. So, I'm sure excited na po tayong marinig lahat ng sasabihin ng fund managers natin. So, here's how we'll go about the roundtable discussion. So, going into this session, we sent in advance guide questions to our guest experts today. And we took into account the advanced questions that we got from all of you. So thank you for sending them in. So we'll try to go to each question one by asking a particular speaker. And in doing so, our hope is to create a picture of the overall market environment. And as you can tell with a line of our speakers this afternoon, we have experts on both the stock market and bond market investing. So hopefully we will be able to form a holistic picture in terms of the investment climate for 2021. So without further ado, let's start our roundtable discussion for this afternoon. So I'd like to recap the stock market trend, and I borrowed this chart from our multi-awarded chief technical analyst, Mr. Juanis Barredo. So he came up with a recent report this morning telling us that the market has broken its immediate resistance levels. And a lot of our clients, actually, this is the question in their mind. Now, in terms of the short-term stock market outlook, where will the market go? So you can see here questions from the likes of Joseph, when are we going back to the pre-pandemic level? Paul is interested, when will the PSCI return to its record highs of 9,000? Or there's also questions like, at what level do you see the PSCI by end of 2021 from Claire? So suffice it to say that our clients are really interested to know what will be the near-term direction of the stock market. So maybe to give us his thoughts, I'd like to call on Sir Phil. Sir Phil, I remember going into 2021, Atram had a house view of as high as 8,300 for the stock market. So where do you see that now, and what are the scenarios that you're foreseeing for the balance of 2021?
Thanks for the invitation today, and thank you for the question. I hope my signal's not that great. I'm trying to get a better one, but we still think we're on track towards 8,300. We had hoped to see it this year, but I think it's because of the I'd say the stumbling block that we hit, which was the additional quarantine period. We did not foresee, in February and March, up to April even. We're pushing back that 8,300 target to maybe this time next year. And I think we're still on a recovery mode. We're still looking at 8,300 as a level that we will get to, and we were working towards that. I think the first attempt is to really get back to where we started the year at, no? At 7,400. And I think finally the last few days has shown that maybe that's a more reasonable level that we should be at moving forward. I mean, it's all really about where earnings are and where the fundamentals are. And in the end of the day, we're in line. We're in line with where we thought we would be. No, and if you look at the data about the Philippines, you know, the economy is back to, and the economy and companies' earnings are coming back to around the 2017 level. No, and we never traded below 7,000 in those periods. No? We traded as high as 9,000, but we never broke the 7,000 level. And I don't think there's any reason we should be trading below 7,000 today, considering you know, the situation that there's at, the earnings that we saw, the macro numbers that we saw, very much support the market being at what we feel is fair value around 7,400 today. So we're hopeful that 8,300 is still a target for 12 months from now. I think that slide shows you the smiley face or the red area. We don't want to be in the red area, you know, and I think when you look at the data that we've received so far, outside of the health crisis blowing up significantly further, there's no reason why we should be down there. And if we can address the health crisis, which we think we're doing, particularly with more vaccination in this second half of the year, then I think we can start to trend back towards that above 7,000 level as the floor. And you know, then we'll work our way towards the all-time high, but that'll take a couple of years still, I think.
Yeah, I have a question, Sir Phil. No? Speaking of vaccination, do you think investors are waiting for a specific percent of the population to be vaccinated to really have conviction? Or do you think as long as supplies are coming in, then the trend will already start the way we're seeing it right now?
I think you have to expect that, well, if you wanted to be ahead of the market, you would have to make a judgment on your own. Will the number of vaccines that come in be executed and used and used up? And lately we've seen as soon as they arrive, the implementation is quite fast. So if you wait for 70% of the country to be vaccinated, which we don't think will happen until the first quarter of next year, I'm pretty sure you'll be buying the market above 7,400 by that time. So the opportunity now is to buy the market below 7,000 with the anticipation that that's what's going to happen. And if you don't see it happening, then you make the adjustments along the way. But that's what we're anticipating, at least.
Mm-hmm. So let me talk about the bond market now. So thank you for your thoughts on the stock market short term.
Sure.
I
Anytime.
showed this slide about the inflation and the government bond yield trend. And you can see here that we really had a knee-jerk reaction because of the supply side issues. So narinig natin sa balita yan yung pork prices or even transport costs, right? So the interest rates also went up. So we've received some questions from our clients talking about the prospects for bond funds. Is it a good time to invest in corporate bonds from Caridad, or merong concerns about inflation? So I'd like to call on Ritchie from Sun Life. Ritchie, where do you see interest rates and the inflation moving? And what would it mean for bond investors, especially as we go to the second half of this year?
Hi, good afternoon, Mark. No? Thanks for inviting me. So for this question, well, upwards, yan yung short answer of it. We think that interest rates can be higher compared to last year, especially. If you take a step back, last year kasi rates were down because of COVID. So BSP had to cut rates, really have to keep the monetary policy easy. So that's why below 4% yung mga rates last year. But heading to next year, I think rates would be challenged, So we can see higher rates. Meaning nito, for investors, especially for the bond fund investors, no, since you don't see yung yield masyado, no, it's really more on the prices. Higher interest rates would mean lower prices. But I wouldn't discount naman na making negative. It's still possible na maging zero to slightly positive, mainly because may mga accruals pa rin in that sense. So since most of the bond funds, they're currently yielding around 3% right now, if you just get the average, then without any price change, there would still be income there of 3%. Now, for my reasons why I think that it can go higher, first is US Treasury interest rates. No? So in this chart that you're flashing right now, you can see there the real rates, no, of US 10-year. So what's real rate? Real rate is the bond yield less inflation. So if it's negative, so you can see that it just touched negative last April. So meaning to say, the bond yields are really low right now. That inflation is even higher, at least inflation expectations, at least for the inflation figure that's being used here. No? So it means to say, regardless of where inflation could go later on, there's a lot of room for nominal yields or for the bond yields to go higher. And as we've seen, we're in a global market. So whatever happens in the US market, the local market will also follow. Now, going to the second reason, locally, I think a while ago we mentioned nga no, na vaccination rollout, it would be progressing, especially in the second half as supplies come in. Now, with more economic activity, the less pressure the SP would have to keep rates low. Though I'm not saying that they would hike rates, but as the market is always ahead of it, that expectation by itself can cause some pressure for interest rates to go higher in the second half.
So with that, Richie, if we're basing on what you said, no, yung expectations na baka low returns na lang talaga for the bond funds, is there a meaningful difference between, let's say, in a fixed income instrument issued by the government versus a corporate bond? Kasi one of the questions na nakuha namin from the client, medyo interested siya looking at corporate bonds. Is it a good time to dabble into those?
Okay. So here in the slide, it's titled Two Different Worlds. So why did I say two different worlds? Mainly because government bonds, they're more traded, more price discovery. So pretty similar with how equities are being traded. No? While for corporate bonds, usually when you buy them, it's buy and forget, hold to maturity type, because they're not that liquid yet locally. That's why you can see here in this chart, for the white line, that's an example of a credit. I use a BPI bond. It's kind of steady. Unlike in the orange line, that's the index of government securities 1 to 3 years. So that comparable, no? You can see that it can really go up high. Then there's of course some retracement. So it's following more what's happening in the interest rates. So very different yung dynamics of government bond and corporate bond. So corporate bond is really more if you want to hold on to it and enjoy the higher spread during that time of issuance.
So would you say, Richie, with the environment today, it's more favorable that you consider corporate bonds over government bonds?
Right now, the drawback naman dyan, if you buy corporate bonds, is you're locking in at the low rates. And if you just hold it to maturity, for example, that's it, di ba? So, kunwari, let's say you buy a corporate bond, let's say it's around just 3% to 4%, then you'll be locking it in for the next 3 to 5 years. While for government bond or in bond funds, for example, it's more liquid. So you can actually trade it. And we've seen already, for the past few years, it's really unpredictable. Like in 2019, spectacular returns, double-digit returns. Last year, when everyone thought that it would retrace some, no, since we saw double-digit returns in the bond funds, it still posted good returns. It's a mid-single digit, mainly because of COVID. So if you're in the corporate bond during that time, for example, 2 years ago, then you wouldn't be able to capture those capital gains. But now, as you mentioned earlier, you asked earlier, what would be a good investment? That would really depend again on the nature or the objective of the investor. If he wants to just lock it in over the next 3 to 5 years, then yes, corporate bonds would have a place in their portfolio. But if they would want to really stay liquid and maybe shift it to other asset classes later on, then corporate bonds might not be the best alternative, especially if you are locking in at the low rates right now. Because right now we're still at low rates, despite seeing rates go higher, no, at the start of the year.
So for your funds, Ritchie, so the answer that you gave was specific for the client. What about your funds? Are you putting more in government bonds versus corporate bonds based on what you said?
Okay, so right now we're not very active on credits. We do have credits in our funds because we think that credits really still have a place in funds, because one, they can increase the yield, and increasing that yield will help support the fund. But right now, we don't want to lock in on the low rates. That's why we think it's better to be more on the liquid side and trade the market. And even this year, we've actually seen a lot of activities in the bond market. I'm sure in the retail side, they don't really see the fluctuations. No? So that's the advantage of investing in a bond fund, because we as the fund managers, we do see those opportunities. Like for example, this year, there's an RTB issuance, and that provided some trading opportunity for the fund managers.
Yeah, okay. Very clear. Siguro, before I move on to another topic, I'd like to get your thoughts very quickly about inflation, Richie. Kasi as one of the clients asked, medyo concerned siya about inflation. How do you see inflation from here on? Is it really supply side driven, or do you think there will be second round effects na tinatawag?
Okay. So for the supply side, yes, definitely it was a factor. That's why we've seen inflation rates go up, over the past few months. And of course, there's also a mathematical reason, and because we're coming from a low base, that's why it's higher. But I think that in terms of supply, we've actually seen 2 months already, two consecutive months, wherein inflation month on month decreased na. That's why we think that inflation may start to be forming at top. But right now, maybe not yet, mainly because of the mathematical reason also. But if you look at supply here, for example, in the slide here, I think the title is kind of cut there, no? But the message here is compared last year, you can see that they're calling for La Nina. And what could cause if La Nina? If La Nina, that would increase prices, no? Especially yung mga agriculture prices, which is a big part of our CPI basket, inflation basket. So you can see that at the start, there's really La Nina. So that could really raise prices. But right now, it's better. Better than weather forecast on La Nina. It's actually at neutral. That's why we're quite constructive that inflation and second round effects can be avoided. That's why BSP, they're also confident not to raise rates despite seeing inflation rates go up over the past few months. They think that this can be controlled, and we share that same view rin naman with BSP. We think that later on, we can expect inflation to go within the band of BSP, which is the 2 to 4%. So not really on the 2%, but lower than the 4%.
All right.
And
So
that's a good thing for interest, for bonds.
Yeah, so very clear, Richie. you're expecting inflation to be sort of manageable for the balance of the year, but the pressures for interest rate to go higher are still there, right? So speaking of inflation and interest rates, I'd like to move on to this topic, talking about specific sectors. A lot of our clients actually sent in questions specific to different companies or sectors. Ano ba yung magiging magandang place for this year? So let's try to dissect each of them. So as I was saying, speaking of inflation, we'd like to find out if the inflation trend that we're seeing right now would have any impact on certain consumer stocks. So here we have the year-to-date performance of different consumer-related companies. And as you can see, it's actually quite mixed between the consumer staples versus consumer discretionary. And we've seen a lot of questions from our clients asking about the prospects of these companies. They even name specific companies like URC, Jollibee, or Pure Gold. So maybe I can have Sir Edser. Sir, can you comment on the prospects that we see for the consumer sector, especially as I was saying, in light of the inflation that we're seeing? Does it have any impact, or we have certain company specific plays that are actually the main catalyst for the price action?
The past couple of days, you've seen a number of consumer plays that had, I think, enjoyed a strong jump in terms of their prices. Some of them are basically more of some company-specific developments, and but predominantly, and some have also, in a way, have some good results during the first quarter, which is also um, it was quite a surprise among analysts. So basically, it's a myriad reason. But primarily, it's because of two reasons. First, there were some company-specific developments that happened within the company. And second, in terms of their first quarter numbers, they basically posted a quite a surprise or a resiliency in terms of their earnings, considering despite of the reimposition of a lockdown during March.
Yeah. So I believe you have some slides here talking about inflation and consumer confidence. Can we go through this and maybe educate our investors as to the link between the two?
Yeah. Well, actually, inflation itself is not bad, di ba? Inflation, in a way, how can it? What are the times that inflation is good to the economy? Inflation, in a way, is good because if there's a slight increase in your prices, and therefore that means that there's basically a higher income or money that basically goes to your seller, and that encourages him or her to produce more, and that increases the productivity, and in a way, also will help the economy. Inflation becomes bad if the inflation is basically goes up or prices goes up that is beyond what the government is expecting. Let's say a fine example, if you see here, the past couple of, this is basically between 2016 and 2021. I think this is during 2018 and 2019. There also suddenly there was a spike in terms of their inflation. Basically, that is being driven by, I think if you may recall, nagkaroon ng shortage or all of a sudden spikes rise ng prices. Price ng rises ng rice, no? So that has also spiked inflation in a way, no? And basically, if you go through the next slide, and that's basically see consumer confidence. And as you can see, during the times na medyo benign an inflation, consumer confidence mo is at medyo nasa positive, and all of a sudden there was a sudden spike in prices. All of a sudden your consumer confidence falls. And basically because una-una, let's say, during the time ang nag-spike up sa inflation and the drive high inflation is rice, and basically that's the staple of all the Filipinos, no? And in rice, also basically if price of rice increases, then yung budget mo as a family will increase. They're going to set aside more on purchasing, the basic necessity in rice. So in a way, as because of that way, yung confidence ng consumer mo hihina. And that basically, if you're, let's say, you're allotting more higher budgets for your food, then definitely your budget for other items will fall. So in a way, that will affect your consumption. Kasi you're now concentrating more of your resources or budget to purchase the basic necessities. And so, and as you can see here on the next period when inflation has started to fall, and definitely nagkaroon na ng recovery sa consumer confidence mo, and that has in a way improved your consumption, because of that confidence. And however, because this period, within this period, dumating yung COVID, and that has really, consumer confidence has really fallen off, and basically that's a different story altogether. But as you can see here, inflation basically I think accounts for a lot in terms of your consumer confidence.
Yeah, so Sir Edser, based on what you said, bottom line, are you bullish or bearish sa consumer sector or selective tayo?
I think right now selective. In general, I think depending kung anong view mo eh. If you're basically, I think, as in your previous presentation or your outlook of my colleagues, they're expecting that there will be a recovery as you increase the number of vaccines that are being administered. So therefore, confidence will start to go back. And I think initially, because at this moment, there's still a lot of concerns. So that's the reason why you have to cherry pick at the moment. Right now, I think there's basically, especially today, after what happened in the market the past couple of days, all of a sudden, the stories are of a market recovery or economy bouncing back or further reopening the economy, nire-raise ngayon. So definitely, with that kind of with that outlook, siyempre, you have to look at, okay, if you reopen the economy, therefore, consumer confidence will improve. Okay, and therefore, you have to look at more on the cyclical names. Those are discretionary, that will also increase your discretionary spending. So you have to look at those consumer names that basically serves the discretionary spending. And again, just to add in terms of their inflation outlook, as if you're basically expecting that inflation will fall or will be more manageable, then therefore, that's the way to go. You have to go to looking at more of consumer names that serves or that provides discretionary spending.
Yeah, so sir, speaking of being selective, maybe we can tackle this question very quickly. We've got some questions about the new IPO, MONDE IPO. So what do you think about this company? And do you think as a whole, this has an impact when it comes to the trend of the market? The size of the IPO is the largest, 55 billion.
Well, I think in general, anything that this kind of size is good for our market. First of all, it really diversifies our market. It provides investors with more choices to invest in. And Monde itself is a good company. Its play on I think both the domestic consumption or the domestic consumer and apply also in alternative meat business. So I think the Monte Nissan going public is good for the market.
Yeah, what about its impact on the current names? Let's say there were questions about URC or Pure Gold. Do you think the entry of this kind of company would have in any way an impact to those existing ones?
I think initially there will be an impact. Siyempre, yung allocation mo ng resources mo will be split. Instead of, let's say, you're just focusing more on two names, you'll have another one that you have to set aside in terms of, in your investment portfolio. But I believe that I think in the long run, this will benefit the sector as a whole because first of all, again, as I mentioned, continue to mention, you have more diversity in terms of which investment you need to pick. I think it all boils down to, of the three, it all boils down to, your choice in terms of um, your basically what will be your outlook. Let's say, kasi these three companies in itself, they're not directly comparable, but I have to correct myself. Pure Gold is not a direct comparison with it as compared to URC and Monde. But it all depends on how on your outlook and what are the consumer names that can benefit from the recovery in the economy. And I think also in the bottom line here, you also have to look at the valuations each of this company.
Yeah, so in effect, sir, for the consumer sector, selective tayo but medyo favoring the discretionaries. Right? So I'd like to move on to another sector. Let's go to banking names naman, sir. So kanina we talked about inflation and then Ritchie mentioned about the trend of interest rates. So let's talk about the impact of the trends of interest rates when it comes to banking names. So if we take a look at the year-to-date performance of large banks here in the country, karamihan sa kanila down pa rin despite the rally that we saw the past 2-3 days. I think only a few yung talagang positives. So we have BPI and Union Bank. And we have some clients sending in their questions about banking names. No? Is it a good time to start looking at banking names? And like I said, sir, paano ba yung impact nung interest rate movement ngayon when it comes to this sector for the balance of the year?
Well, that is no. I think again, look at the let's look at first on the state of economy. And as you can see, I think this is the more again. This is more of the in relation to inflation. No? So the question is, what will drive yung mga banking stocks, no? And whether it is a perfect time to buy right now. I think initially banks right now, I think in terms of growth for this year, it may still be a challenge. First of all, looking at the loan growth has been different. This is the first time that has as you can see here in the chart, this is the first time that the healthy loan growth that we've been experiencing the past 4 years has been interrupted, because of the pandemic, and we've been experiencing a contraction in terms of the loan growth so far as of the first quarter of 2021. I think right now, if you are basically a long-term, if you have a long-term outlook, then banks right now are a good investment. First of all, if you look at the price to book valuation, the price to book right now are basically at their historic lows. Okay, and if ever, let's say, you're expecting that, and as what again Phillip mentioned a while back, I think in terms of looking at A3 for next year is highly probable. Then definitely um, banking sector is one of the sectors that you have to be in. Kasi if right now loan growth might be weak, but if the economy recovers, then therefore industries will have to expand. And one of the key things is funding. So those industries will have to go to the banks to borrow. And in addition, I think there might be some questions about the concerns on NPLs.
Yes.
Um, I think so far NPLs are quite manageable right now, and I think because of their lessons during the ASEAN crisis and during the late 90s, they've already made a lot of provisions to in a way they're now anticipatory. So and so far the past couple of months or the quarters we haven't seen, although there has been a trending increase in NPLs, it is not as alarming as we had seen before during the late 90s. So in a way, I think banks right now is also a good investment if your outlook is basically on a long-term outlook.
All right. So very clear for consumer names, as Sir Edser said, medyo selective pa sila, favoring the discretionaries. And then for banks, long-term tayo, despite the trend that we're seeing right now. It will be a good reopening play, so to speak. Now, thank you, Sir Edser. I'd like to move on to another topic. We've talked about this a while ago with Ritchie, and you touched on it as well, Sir Edser. And we got some questions about this, the policy of our BSP, again, inflation coming into the picture. So I'd like to get your thoughts, Sir Sem. What do you think is the impact of the moves of the BSP when it comes to interest rates? And moving forward, do you agree with the view of Ritchie that BSP will just keep their stance? And also, before you go to your answer, sir, I'd like to share with our viewers that if we take a look at the trend abroad, we see that the US Fed, the US Central Bank, has also kept their policy rate unchanged, but they're also feeling the same pressure. So you can see here yung inflation umaakyat na rin. So actually, we've heard a lot of talks na baka sa US Fed mag-increase. What do you think will happen here on the ground, Sir Sem?
Okay.
Yeah.
Yeah. Okay. Going back on my previous presentation, I think there's basically in terms of the policy rates.
Yeah, go ahead, sir.
Yeah. Okay. If you go back to the yung mga policy rates, no, they've despite of the increase in inflation, the BSP continue to be accommodative, di ba? And I share the belief that it will remain at that level, considering that I think the BSP hasn't yet seen any signs of a solid recovery in our economy. And I think that's basically my belief. Now, the next is sometimes ngayon nagkakaroon nga, and as you can see here on the fixed income yields, no, there's basically now yung gap between the yield, the 10-year yield and inflation nag-narrow na, no. Actually, there are certain times na talaga nagpantay na. So basically because of the liquidity, that is basically there's a lot of liquidity in the market right now, and that's the reason why yields have narrowed between inflation and the current yields. But eventually, that will, I think, expand. But I think in general, in terms of the BSP stance, I share the belief that they will be maintaining an accommodative stance, because there's still no, I think, a very solid evidence that the economy is recovering.
Yeah, thank you, Sir Edser. So we have two experts now saying that BSP would likely maintain their policy stance. How about you, Sir Sem? Do you share the same belief? And what do you think will what do you think will the bond market be at given the current policy rate ng BSP?
Yeah, hi Mark. Yeah, we believe that the Bangko Sentral actually will keep interest rates steady, as they have actually said it many times in during their monetary board meetings. This chart, actually, what you're seeing right now, is what they did last year, and as you can see, they have cut actually interest rates several times last year, bringing the interest rate, the policy rate, from a high of 4% down to 2%, and cutting it several times, anywhere between 25 to 50 basis points per meeting. Actually, they even cut on a particular month where there was an unscheduled monetary board meeting. So that caught the market a little bit by surprise. So that was last year. But since this year, actually the monetary board has met about 3 or 4 times already. And each time they kept their policy rate steady, and each time their message was clear, at least for the Bangko Central Governor. Jokno has always been saying that if they will keep their accommodative stance steady and will keep interest rates where they are until probably next year. As you were showing earlier, also in the US, we're seeing the same thing. But for the same thing for Federal Reserve Chairman Powell, he has been saying the same thing, that they will keep their accommodative stance. Both the Bangko Central Governor and the Federal Reserve Chairman maybe have the same objective in mind, which is to support their respective economies. So in the case of the US, they're saying that the Federal Reserve will probably not change their interest rates until probably 2023. So there's actually a little bit more time for us to see this low interest rate environment, and whether it be domestic or in the US.
Mhm. But there's also a camp, Sir Sem, saying that central banks could be behind the curve. Now, if we take a look at the inflation and even the trend in US Treasury yields, parang nauna na sila compared sa policy rate ng US Fed. Do you think that is really the case na medyo behind the curve na yung central banks?
I think for one, especially more so on the local front, um, we're still seeing negative GDP contraction, at least for up to the first quarter, no? And in terms of the vaccine rollout, we're still way, way off from where, well, the government's target is supposedly around 58 million Filipinos to achieve a certain uh, point of herd immunity. I think we're somewhere around 4 million. So we have a long way to go. And so I think the accommodative stance on the BSP side is actually appropriate. In terms of the market moving ahead of the Banco Central, or in the case of Federal Reserve, that's normally the case. The market always moves ahead, trying to anticipate what the Banco Central or the Federal Reserve will do. And as you will see, actually, both of them are more deliberate nowadays in terms of telling the market what their forward moves would be. There was a time actually when the Federal Reserve, if someone goes back to 2013 or so, there was this taper tantrum wherein the market got ahead of itself because the Banco Central, the Federal Reserve was talking of, mind you, talking only, talking of probably reducing the amount of bond purchases they were doing in what they call their quantitative easing program. They were just merely talking about it, thinking about it, not actually doing it yet. And the market got ahead of it. And we saw a downtrend, big downtrend on that year. So I think this time, these two central bank governors are actually doing the right thing. They are more like telegraphing what they will be doing, going forward, and so that the market doesn't do the same thing that it did back in 2013.
Yeah, but with the current policy stance, sir, do you also agree with the view of Ritchie that rates are likely still to face upward pressures?
Yes. Well, for one, the inflation will really go up. One, because the markets are economies are being opened up, the lockdowns are easing, the mobility restrictions are likewise easing. So there actually should be more consumption going forward. Now, in the US, there's also a lot of stimulus plans that been passed through their Congress. And whether that money falls in the hands and the pockets of more Americans and then they consume more or spend more, that will translate into more inflation as well. So that's in both local and domestic front. However, I think everybody from the beginning of the year actually really thought that interest rates would go up. A lot of the calls back then were for the US Treasury, 10-year US Treasury from about 0.9% to go up to maybe 2%. But the thing is, we saw it go up all the way to 1.7 immediately in Feb and March. So I think that was a bit of a drastic move in terms of where interest rates were had moved in terms of the magnitude, but the direction was still the same. We expect it to go up towards the end of the year, but gradually.
Mhm. Sir, very interesting point that you mentioned, no, yung interaction between what's happening in the US and here locally. And before the event started, we were talking about this. And I guess some of our clients are wondering, gaano kalaki ba yung impact, halimbawa, nung movements talaga nakita natin abroad? Or do we know of the foreign presence? For example, here in the local bond market, meron ba tayong ganun, sir?
Yeah, it's a bit hard to pinpoint uh, foreign presence on the bond market, unlike what you see on the equities, wherein actually every day, actually, I see the amount of foreign selling from the market. That's not something that is transparent on the fixed income side. However, we can say that in terms of the interaction that you were saying earlier, I think in terms of inflation picking up last year, it was, and for interest rates going up, they were pointing at two particular reasons. One is the inflation scare. Second is the interest rate increase in the US. So in the interest rate increase in the US, the one that they're really looking at normally is the 10-year US treasuries. And for that, it went up from zero point 0.9 to 1.7 as early as March, but it has come down a bit to about 1.5, 1.6 as of late. It's notable to show that during that same period, as of end March, the 10-year FXT and locally also went up. At the beginning of the year, we were at 3%, and it had gone up to about 4.4. Also, as of the end of March. So somehow there is some correlation between the rise in interest rates in the US as well as that in the Philippines.
Yeah, so thank you, Sir Sem. So as Ritchie and Sir Sem mentioned, looks like in terms of policy rate, walang changes that we can expect, but interest rates would still likely to face upward pressures, and we still have to watch for what will happen outside, particularly yung US Treasury rate. So may impact din yan sa local rates natin. And since we talked about the foreign presence, I'd like to move on to the next topic. So one of the key elements that we've seen since 2020 or even 2019, particularly on the stock market side, was actually this one, yung consistent, relentless foreign selling. In fact, if we take a look at this chart, talagang ang lalaki nung selling na nakikita natin from the foreign side. In fact, I think I saw a stat in 2020, over 90+% of the trading days during that year, we saw net selling from the foreigners. And then this year, I think for the first 18 weeks ng taon na to, 2 weeks lang yung nakita nating foreign buying. So for the most part, foreigners have been selling. And some of our clients are wondering, what are the major factors that will weigh in the foreign funds or these investors coming back to our market? Or ano yung catalyst that they're looking at? Or what are the causes for this persistent net selling? So maybe I can ask Miguel to comment on this. Miguel, based on your experience, maybe on the stats that you're looking at, what do you think is the main reason why foreigners have been selling? How much more can they sell? And again, what do you think would it take for them to come back here in the Philippines?
Okay. Good afternoon, Mark.
Yeah, good afternoon, Miguel.
Okay,
Nice to see
well,
you again.
yeah, anytime, anytime. I support call. You have a number of questions. I'll try to address them one by one, but I'll do one first. How much do they have left to sell? You know, that's really the million-dollar question. Whoever knows the answer to that's going to make a lot of money. But, you know, there'll be some indicators which will tell you how close you are to whether they're done selling or not. Before I address the other questions, I want to show you two of my slides from old presentations, which I showed weeks ago. And I want to show the audience the very last slide of the presentation, which is this one. So in the presentations previously, this is the very last slide of my presentation. And I'll quote, ultimately, the market's direction depends on a medical solution, not only in economic, monetary, and fiscal policies. If you note the previous bear market, which was '08, those were really the central banks intervening. And really the mantra then was don't fight the Fed. This time around, though, central bank action alone will not be enough. You really need to end the COVID-19 epidemic in a particular country for economy to rebound. So just so you know the interaction, if your daily caseload goes down, the economy can reopen faster, corporate earnings can recover quicker, and therefore stock prices will move up. So that's your logical causation. But of course, stocks being a leading indicator, they will start pricing that in. Okay. Now, daily cases are one thing, but the other one is the vaccine rollout. So on the vaccine rollout, there is encouraging info on that, and I will get to that later. But as you did mention, the foreign selling has been quite heavy. And it's not just since 2020 or 2019. If you look at the next slide, next slide. Okay, so this is another slide I showed in my presentations about 2 to 4 weeks ago. So what I was saying there is, if you look at this, in red is the foreign ownership of the PSEI. So that's the benchmark index. In blue is the foreign ownership of your total market. So this is something we track. And this will tell you how much the foreign have actually been selling, not just in peso terms, but as a percent of your market. And I noted in the previous presentation that with MSCI rebalancing coming up already, you're going to see more foreign selling. And that MSCI rebalancing actually concluded yesterday. And we had about 23 billion in volume. And the net foreign selling yesterday was about 890 million net foreign selling. And as you see, that trend has been continuing for a while. But I want to note, so just today, and this is fresh for those who are watching this presentation, we actually hit net foreign buy. 917 million net foreign buy just today. And note that despite the net foreign selling yesterday, the market was up a very significant 5.1% in one day, 7.5% in 2 days. So I doubt these foreign funds are going to zero this out, okay? Well, I don't think we're like war-torn level country which got neutral, right? So they're not going to zero this out. But clearly, can they still sell? Yes. The question is, will they still sell? And if you look at the vaccine rollout, which this was very important. We wrote about this in our Philequity Corner article, which came out on Monday, 4 days ago. And we will be writing about this market move for our Philequity Corner article on Monday. So this comes out in the Philippine Star. So what we wrote 4 days ago is, if you look at the vaccine rollout, okay, 4 weeks ago, it was about 35,000 per day. 3 weeks ago, it was 68,000 per day. So these are 7-day moving averages. 2 weeks ago, it was about 105,000 per day. And the latest 7-day rolling average is already 160,000 per day. And note that this is happening without private sector intervention. Now, why did the market move the way it did despite your foreign selling? And why did the foreign buy a lot today? Someone is probably tracking that data, and some foreign funds are actually early.
Yeah, so to the question about what would it take for them to go back, what do you think is the answer to that, Miguel?
Well, if the vaccine rollout is implemented swiftly and effectively, if the government can continue to surprise, as you can imagine, expectations were not very high. But if you look at the vaccinations now, they've gotten very fast and they've picked up a pace significantly. that will send your foreign funds back. Now I'm gonna give everyone a clue, but not everyone has access to this. I guess the guys here on the forum have access to this, but something you can look at. It's called the Bloomberg COVID Resiliency Tracker. Okay, if you look at that, and that is something updated by Bloomberg, for the most part of the past 9 months, whatever your rank there is correlated with your stock market performance. The Philippines has been maybe number 47 out of 53 or some insanely low number like that. And naturally, we are the worst performing Asian market as a result. Okay. But with your vaccinations picking up, from being down more than 13% year to date, the Philippines has already erased half of its year to date losses in just 2 days, because those vaccinations are picking up. And the expectation was with MSI rebalancing, our market, dudurugin dapat bebentahan which was true, binentahan, pero may bumili rin. There were other funds that said, okay, we will use this as an opportunity to buy because we see light at the end of the tunnel. Because even though earnings have not recovered, they're going to forward look a recovery of the economy and therefore recovery corporate earnings, and that's what will move your stock prices. Valuations alone will not make these foreign funds buy. Okay, even if you say we're cheap or 50% discount to now, whatever, for certain companies, they will not buy. There has to be hope. There has to be certainty that there will be more growth, above forecast growth, above trend growth moving forward, because we're coming from a low base. And other than controlling the number of infections, you need that mass vaccination program to, really speed up. And that's what I think moved the market.
Yeah, so very clear ang sinasabi po ni Miguel, talagang yung mass vaccination na yan would be a key catalyst for these foreign funds to possibly come back in a big way, much like how they are selling our market right now. But just one last question on this topic, Miguel. Despite the selling, and as you said, yung with the MSCI rebalancing, quote unquote, dudurugin tayo, no? We still saw the market being resilient. And that's largely because of the local participation. What do you think of a local-driven market rally? Is that something sustainable kung walang presence yung foreign?
Just to explain, the market can go up without foreign participation. As you have seen, like say yesterday, the market was up 5.1% despite net foreign selling. But for the market to have a sustained recovery and not just, blips that will last for a few days before correcting again, you need the foreign funds to start coming in again. You need net foreign buying. So like if you look at this, clearly, if you're just following technicals, we may have hit an inflection point already with the move in the past 2 days. I am not going to discount that you may see a correction or it may continue moving higher. It'll be hard to say, but certainly a correction is healthy given a move like that. But it goes to show you, even with net foreign selling, the market can go up that much. And note that normally after a 5% move in one day, you'll probably see a correction the next day. Because the foreigners were buying in a big way today, the market did not correct today, despite expectations that it would do so. So that goes to show you that yes, we can go up without net foreign buying, but a sustained recovery needs your foreign funds. Back in 2019 and previously, 50 to 60% of our turnover comes from these foreign funds. And the reason we've been underperforming for the past 5 years is because these funds have been selling continuously for the past 5 years.
Yeah, so certainly a space to watch if we would think that the rally that we saw the past 3 days would be any more sustainable for the balance of the year. So thank you for your thoughts, Miguel. I'd like to move on to some other topics, particularly sectoral issues again. So siguro what we can do is visit the defensive sectors first. We had some questions about telco stocks. And just to show the performance year to date of some stocks, kita natin there's a clear winner. It's the newcomer Converge, while the incumbents and even si Dito, they're still in the red. And actually, there are a lot of questions, particularly about Dito. But let's talk about the telecom sector as a whole. Sir Edser, what do you think about this sector? What are the prospects that you see? Nasa radar nyo ba to? And can you quickly comment on Dito?
Uh, And I think in terms of the sector, the reason why medyo nakita mo sa price performance, medyo isa lang nag-stand out. That's because if you look at the, can you go back to the slide? Yan, nakita mo, di ba? There's basically there's a big difference, di ba? What do you see? Let me ask this. What do you see? What is the main difference, between the three ones and this one? Okay, the main difference is these three guys, they're basically in the wireless business. Similar. Okay. And the reason why Dito came in, when reports that the third player will come into the picture, and then a lot of people started to shy away from these two because they're expecting that because of the third player, competition will increase, and therefore their earnings will basically be affected. That's basically the story why the three names have been fairly weak. And the reason why this company stands up is because they're basically operating on a niche market, which is underserved, especially right now with the pandemic situation, and a lot of us are doing work from home. So therefore, there's an increase in terms of the demand for bandwidth or for broadband services. Now, I think some will ask, yung dalawa naman ito, they also have a broadband business, di ba? Especially this one, because they basically have the largest network. Well, the main reason why people hasn't really, I think, paid attention, too much attention, because they're basically, while one of their businesses will be doing well, but the fear is it may be dragged by the weak wireless business. So this is the reason why the share prices are weak. Now, there's basically another question about why it had underperformed. I think it's just basically more of a lot of people. I think last year Dito was one of the best performing stocks. Correct. I think now Dito is now in operation. It's basically just waiting for, okay, san na yung IMO? That's what the people are now waiting for. So initially, before they started operation, a lot of things are, I think, a lot of expectations now, and which is quite ironic. Once it's already operational, then people will start, okay, where's now your earnings? So basically, I think that's the reason why it went weak. And admittedly, I think last year it's one of the best performing names, and I think it's just a matter of time. A lot of people will start to take profits from it.
But as a whole, Sir Edser, when it comes to telco stocks, is this sector something in your radar for the balance of 2021?
Yes. Kasi unang-una naman, while they offer some defensive, diba? But I think going forward, we expect that communication will remain important, despite basically despite the return to normalcy. I think people have started to feel the benefit of their expansion, the improved quality, especially right now, because a lot of people were stuck in their homes, and they're glued into their computers or their smartphones. And I think moving forward, I think that trend will remain the same, considering they've already experienced the speed and convenience. Let's say in terms of online shopping, they've already experienced the convenience. So I think we're not, that will continue to be a growth moving forward.
All right. So looks like the telco industry will remain to be a quote unquote defensive nga given the nature of its product. Now on to another defensive sector, going to utility stocks. So here are some performances of utility companies, power related, more particularly so we have ASEN, FGen, Meralco, Semirara, Manila Water, and AP. I'd like to get the thoughts of Sir Phil. Hi, Sir Phil. Do you have anything that you're looking at dito sa utility sector? Any particular story, or is it of the s- part of your strategy that you're looking at for the balance of 2021?
Yeah, part of our strategy is to be underweight utilities. I mean, that's the that's the reality of it all. No? Right now, we're looking for growth opportunities. That's what we're looking for. No? Now, there's not. That doesn't mean that we don't own any of these companies. I think there are a few companies that we own in some of our funds. ASEN, FGen, and Manila Water in particular are three companies that we like. You know? Each for their own, special thing. I think we don't be in utilities and telcos, for example. We will look bottom up and find where the growth opportunities could be. No? And so I think for ASEN, it's moved very quickly. That's all I can say. I think there is some consolidation due there. It's moved ahead of its buildup in capacity. But because of the sector it's in and the approach to that, which is clean energy, that I see that this company will carry a premium in the future and will be a favored company when people want to be exposed to the energy sector. No? So there's that opportunity. For FGen, I think FGen's a great example of, we talked earlier about all of these foreign outflows, right? And money flowing out, money flowing out. But what about one of the smartest investors in the world, KKR, buying into FGen while everyone's pulling out of the Philippines, right? I think you have to really weigh these things because one big impact, and I'm not sure if anybody on the call has the actual data on it, I think we can find it, was the inclusion of China into the MSCI was inevitably going to take weight away from the Philippines. And we knew that was going to happen over a period of time, right? So I think we should have probably anticipated, and obviously being double whammied with the pandemic, maybe it felt even more aggressive. But we're now 0.4 of global indices, right? Or Asian indices, and even lower on the global side. I think most of the rebalance to do with China is done with. No? So maybe it's these signals of smart investors like KKR putting money in the Philippines that will lead the way. I mean, you need to have some folks starting. I think earlier it was talked about 900 million in inflow this week, right? Next week we have the MONDE IPO. I think we're going to see 700 million in inflow. So are we saying that in 2 weeks we could have over $1 billion dollars in inflow because of this activity, right? And so things can change real fast. Is my point. And I think looking at growth is our opportunity. Manila Water is another one that we look at with a growth angle rather than utility angle, because the new ownership there has proven to be able to export the expertise, something that you want to look at for Manila Water, right? Even today, without that, we have a fair value that is higher than where the market's trading for that stock. So, is this the time to look for safety? I think that was last year. This might be the time to start looking for growth. And within the utility sector, you can find those answers, no?
Yeah, thank you, Sir Phil. Very clear. So while generally in terms of your strategy or underweight, there are pockets of opportunities here that you can look at, especially if your perspective is growth. And I like what you said, that maybe this is not the time to be defensive. And to go to another topic, I'd like to highlight the fact that in terms of the flows that we're seeing for different mutual funds, a lot of flows we saw actually went to money market funds. So maybe it's talking about being defensive or looking for growth. Maybe I can get the thoughts of Richie. Richie, what is the reason why money market funds have attracted the kind of flows they have? And do you think this is the case of people waiting in the sidelines, or talagang conservative lang sila by nature?
Yeah, I think the main reason is yields. There's better yields in the money market funds compared to their alternative. Most likely, their alternative is mga time deposits. So time deposits, it would range around 0.2% if you factor in that tax. No, so I think here you look at the Metrobank 0.25. So 0.2, then the highest that you can see on a random survey, 1%, 0.8% yan, net of tax. And if you look at other money market funds, that can range higher than that. Like for example, for our fund, we're at a 1.5% net. So that's already including of the fees and the taxes. So by itself, that's why people are flocking in. And naman, in the Philippines, there's still a lot more in cash, in deposits rather than equity bonds. So it's just really shifting from that asset class to the money market. And then in terms of your question, if we think that it's coming from those asset classes, no, like looking at the net flows, no, you can really see that the inflow into the money market fund came not from equities or from bonds, even though we saw some net outflows there, but it's really more from the time deposits. So I think the risk appetite for these money market fund investors are really more on the conservative side rather than looking for the upside of equities and bonds.
Yeah, that's a very good point, Richie. For those investors who may not be really familiar with how to use a money market fund, how do you think this kind of fund fit into a portfolio, let's say, of an equity client?
Okay. So it can be used as a parking fund, for example, of an equity fund, no? Of an equity investor. So for example, for an equity investor, they would like to time it. If they want to time it, then they can first park it with a money market fund while waiting for that opportunity to come in. Another one would be, it can be a starter fund, meaning to say if you're just starting to invest, for example, in call, in fund source, maybe you want to start with the least volatile one. No? So that's the money market. So you can see here in this slide, it shows the different returns of equity, fixed income, and money market. And as you can see, it's only the blue one, money market, that consistently showed positive returns across all those years for the past 6 years. While for equity and fixed income, they do exhibit higher returns, but they also have some negative returns. So it's really more of a starter and parking way of for an equity investor. But if you really want that upside, then money market is not really where you want to be invested in.
Yeah, thank you. So very clear, Richie. It's something that if you want to, let's say, balance your risk or even put your money while waiting for opportunities, nandyan yan. And as we've seen, the kind of flows going into this kind of fund has really been quite massive over the past few years. And maybe to a certain degree, it's also a cash that could prompt the market to go higher. So let me go back to some sectors just to complete the picture for our stocks. So looking at conglomerates, for example, here are the performances. So largely, conglomerates have been hit, and that's the reason why the market is still down year to date, even if nagkaroon tayo ng rally the past 2 days. And some of our clients have actually been asking about this kind of stock. So maybe Miguel, I can have you comment on this. What do you see for conglomerates for the balance of the year, especially since they form a big part of the PSEI, our index?
Okay, good afternoon again. Compared to Phil, I got the sexier sector. No, conglomerates are, most of them are, depending on what's in them, you can say most of them are classified as the opening place, as nearly all of them have a bank in them. Many of them have property subsidiaries in them. And the fact that they comprise a very large part of the index, for example, SM is like #1 of the index, right? If a foreign fund wants to re-enter the Philippine market, they would have to buy SM, they would have to buy Ayala Corporation, and going down the list, JGS, Metro Pacific, etc. So if you believe that the mass vaccination rollout will be swift and effective, if you think the economy can start reopening gradually and will be in a way better place 12 months from now than where we are now, then like what Phil said, you want to buy reopening place. And conglomerates, most of them provide a very good snapshot of the reopening sectors in this country. So assuming everything goes well in the coming quarters, these stocks will continue to price in that recovery and their prices will trend higher. Although you can imagine not all conglomerates will be made equal. It's a function both of balance sheet quality and sector exposure. Some of them will tend to do better than others.
Yeah, any quick comments on what we see in front of us? MBI, for example.
Okay, MPI has been a perennially cheap stock, and that really has lots of room to run. Once the economy reopens, I mean, you're gonna see more of more cars on the roads. You're going to see more electricity usage, and then that should boost Meralco. The regulatory overhang was removed from Maynilad already. So it's looking up for Metro Pacific and a lot of conglomerates as well, going into the next 6 to 12 months. But really, it's a function of execution. If you remember, in October, November, December last year, our market went up on hope that there would be a vaccine. And there was hope, and that hope for vaccines must now turn into reality, which is your vaccine rollout, your inoculation. So a lot of the move for conglomerates or whatever sector hinges on that. Okay, and the recent data is very encouraging, hence the move you saw in the market recently.
Yeah, so speaking of more reopening plays, Miguel, your thoughts naman on property sector. So if you take a look at the property names, more or less much like what we saw with conglomerates, battered din itong mga to. As you said, it's reopening play probably, and there are questions about this. So your thoughts on property sector?
Okay, I'm gonna keep this brief because I know you guys are running out of time here. But the short answer is it's different for each property company depending on your exposure. Okay, so I'll just try to explain briefly. So you have residential, which is your condo sales. You have office, and then you have malls. Okay, so if you coming from a low base last year, I mean you will definitely see overall positive growth, right? The question is which ones for say on the condominium side, which one of them will be able to start launching new projects, which will be for your future revenue streams. But for your income in the next 12, 24 months, it's going to be a function of completion. Okay, and if those who are able to really get more of that capacity of construction and complete projects, and therefore be able to book it, they're going to have better earnings in the next 12, 24 months versus those that have bottlenecks in terms of construction. So for all those who have bought condos and noticed they're like delayed for 12 to 24 months, you know who I'm talking about. Don't want to say who they are. So that's one on the condo side. So launches are one thing that's really for your future unbooked revenues, but for the immediate 6, 12, 24 months, it's going to be a function of completion. Okay, on the office side, it's going to be a dichotomy of two things. One, if you are heavily exposed to POGO, you know that a lot of POGOs left, okay? So you're gonna get double whammy on two things. Number one, you're gonna have higher vacancies. Number two, the POGOs, both for condos and office, paid humongous rents, okay? So assuming you're able to solve your vacancy problem, the question is the replacing tenant at what rate is he going to pay? He'll probably pay market rate, which should be less than the POGOs were paying. So those which have a lot of POGO exposure are going to get harder hit. Now, the only way you can possibly offset that is if you have a lot of PEZA office space, okay? Because there's really high demand for that. And those with a lot of PEZA office space, I believe, can replace those clients very quickly and at rates that are pretty good. I mean, not POGO good, but pretty good. So that should, so depending again on the mixture of your office, that's going to benefit you. It's going to be a problem for you. Now for malls, the malls in the provinces are doing better than Metro Manila. And just to explain to you what's happening in Metro Manila, foot traffic is about 40 to 50% of it was pre-COVID, okay? Now, just looking at that straight off, we're like, okay, that means mall revenue is 40 to 50%, right? Not necessarily, because if you look at basket sizes are also about half of what they were pre-COVID. So like net, you're like 1/4 in terms of spending in the mall. And a lot of stores have chosen not to reopen or are under rent schemes that are, say, more favorable than they were 2 years ago. So as the economy reopens, these things will improve. But in the past 6 months or in the immediate 3 to 6 months, you're not going to see a sharp jump in that yet. So again, it's really the confidence for them in people being able to go out, people getting their jobs back, which will allow them to spend more in malls in other places. And in property, last to recover will probably be tourism. Like, unless you're like the YOLO, I'd rather go out and risk dying and get stuck in a box with windows. I mean, how many people would probably risk going out without being fully vaccinated, right? So that sector will probably be the last to recover among all of them. But fortunately, among the big companies, their tourism exposure is not that high. So it shouldn't be that painful on that side.
Yeah, all right. So conglomerates reopening play here in property, we probably have to be quite selective based on
Yes,
the factors that you said, no? Whether
correct.
mall yan, residential, or leasing, especially as you mentioned, the ones with exposure to POGO. Now, I'd like to go to some infra stocks. Maybe I can get the thoughts of Sir Phil here. So we see construction-related stocks like EI, Eagle, CHP, Megawide, all of them are in the red. Sir Phil, for the second half of the year, do we think it would be a better environment for these companies?
I think the environment is right for the infra companies. I mean, we've never had a situation coming out of a crisis where we've had so much on the plate as far as projects to execute. No? I do want to comment though, because all your slides are showing red numbers, right? And we have to understand the market's down, right? 12% this year. So for example, your telcos then, they outperformed. It's just Dito that underperformed. Here you've got EEI outperforming the market. Why? Because I think they're the proponent of a lot of big projects now. They seem to be the preferred contractor of the big three for many of the large projects tied with the San Miguel group. So I think EEI has been quite stable and their order book is, I think, larger than it's ever been. Eagle, I think, Eagle cement, we should start to see supply or demand pick up, but we all know construction has been lagging significantly. And for Megawide, they're double whammy. They have investments in an airport that unfortunately is operating at a very similar to the malls, right? A very low turnover there, and then the construction business suffering as well. So they've had challenges, but like I said, I think we've never had a situation coming out of a crisis where the amount of infrastructure projects that are out there are significant and are not just one-offs. These are big game-changing infrastructure projects. No? And unfortunately, I was let down by one today because I did travel to Subic and was expecting to use the Skyway for the first time, and the on-ramp was being tested. So I ended up 1 hour in SLEX up to Quirino, diba? I mean, back to the old days. But anyway, this is the opportunity, I think, for infra stocks. But they have challenges, right? They have debt they have to worry about. They have the construction margins are not fantastic margins. They're very steady margins, and so it's about getting people back to work in a safe way, and how quickly that can scale up is going to be important for these companies. But again, a sector that we're selective. Like I said, I think we own a few companies in this sector for that reason. And it's not very well represented in the index. So it's a very thin sector when you look at the index proponents. No?
Yeah, so speaking of another sector with a thin component in the indexer, what about the mining sector? We have some questions from our clients here. Unfortunately, I don't think we really have a lot of large companies when it comes to the mining sector, but we've heard some
Yeah.
news about the moratorium being lifted, or even commodity prices making a run, like uh, iron ore, copper, or even nickel to a certain degree. So some of our clients are asking about the mining sector. Any thoughts on this sector, Sir Phil?
Yeah, I mean, this sector has been, used to be the most important sector for the market back in in the day. Philippines was a major producer of copper in particular, and gold as well. No, but if you go to the slide that I put, and it's just a visual that kind of gives you a cycle of a mine life. No, I fear that a lot of our mines that are operating are at the end of this cycle where their mine life is depleting, and they need to go back to the beginning of the cycle, which they did. I think I think in the 90s and in the early 2000s, there was a lot of exploration going on. The problem was that we couldn't execute. Right, there's been a moratorium on executing, and the Mining Act is being reviewed, etc. So the question is, at what point in the cycle are these companies in? Right, if you're at the point of still exploring, that's exciting because there's a lot of speculation in the exploration side, right? And the minute you have a big find, your stock normally flies. But then the realization hits, oh man, how much money is it going to take to bring that ore out of the ground, right? And how long is that going to take? And that's when you see the stock kind of falter. Before you're able to get the money you need and then start executing on building the mine and excavating the ore. And then your stock starts to recover. Where are we in this cycle for companies? So depending on the company you're looking for, try to understand where you are in this cycle. If you're still in the exploration side, that's great, but you have to be fast because it's very speculative. If you're beyond that and you're already in the fundraising, so for example, with Felix, I think the big opportunity is not what they're doing today, but the future, silangan, diba? And that's already been explored. They already know how much it's going to take to start to mine that ore. But I guess depending on the law, could it be the cheap way or the expensive way, right? That's still not very clear. But that I think is in this good part wherein Felix would be a very strong candidate for investment if it's clear what they're going to do with Silangan, and because their current mine is at that tail end where the ore is running out. And I think for every single mining stock, you have to take that same view. What are you doing today? Are you doing something? Are you mining or not? And if you are, then where's your mine life and where's your new opportunity? And that will help you understand where the stock might be going on the speculative side, and basically on the reality hit side when you realize this is not cheap. To take ore out of a mountain, it's not a cheap venture, and it requires capital, and that's when things kind of settle down. No?
Yeah, so thank you for your thoughts, Sir Phil. So it looks like both the mining and infra related stocks would have their own individual challenges, and we really have to be probably extra selective as compared to the index names that we discussed in the previous
Yeah,
slides. And
I feel like I did something wrong. You punished me with these sectors. Miguel got the sexy conglomerates. By the way, Miguel, I've never heard anybody call a conglomerate sexy, but
yeah,
good
exactly.
on you, man.
Compared to what you got, I mean, right?
Yeah, so maybe Sir Phil, for our last sector, you can comment on this. There's a question on some aviation
Airlines. Oh
stocks,
God.
airlines. Yeah.
Okay. Well, what choices do we have, right? Well, globally, I guess you can think of it, right? But the one we're looking at, obviously, is Cebu Pac. That one is something you have to look at. Um, and ironic, I'll use the word runway, right? You need the cash that'll give you enough runway for the business to take off again. And I think Mr. Gokong Lance secured that with the deals that he did recently. No, there's a bond, a debt deal, and I think a pref deal, and I think that has given him the runway to allow the business to take off. I think he's got 22 months, and that should be enough time, right? If we can get to where we think we should be by the first quarter of next year, then then I think Cebu Pac should be ahead of the game. Should be first off the gates and first to take off. No pun intended.
Another reopening play, Sir Phil, right? Okay, so I guess we've covered most of the sectors in the PSE. And perhaps just to close our roundtable discussion, I'd like to quickly get the thoughts of Sir Sem from BME. Sir, going back to fixed income, speaking of reopening, since we talked about some possible reopening plays on the stock market side, if we were to completely go back to where we were in terms of our economy, we can see here on this chart na yung budget deficit natin has gone up because of primarily the pandemic, and yung debt to GDP natin medyo umakyat din. Are there concerns about the credit rating of the country as a whole? And what do you think would the impact of that have on our fixed income market?
Yeah, hi, Mark. Yeah. With regard to the concerns on debt to GDP, I believe that, well, the government is wary of what it should be looking out for. I believe one of the limits that international credit ratings are looking at is roughly about a 60% limit. Now, there have been pronouncements from the government. They're quite wary of that, and they will keep our government's debt to GDP ratio within that particular limit. And that is just one of the measurements or criteria that these international credit ratings look at. And actually, as recently as yesterday, actually the S&P has kept its triple B rating on the long-term ratings of the Philippines with a stable outlook. So that's actually quite positive. That says that the S&P actually expects the country's prospects for an economic recovery to be quite positive, and then it will probably improve from here on out for as long as the government's vaccine rollout continues. So a lot of it is actually riding on how the vaccine rollout of program of the government will be moving forward from today.
Yeah, so clearly, sir, this is not something that should be a cause of concern for our investors. No? Yung pagtaas ng debt to GDP or the deficit, I think it's a given because of the pandemic. So as you said, the S&P 500 affirmed our credit rating na triple B plus. Okay?
Yes, just
So
yesterday.